Imagine this. You're about to buy your first car, and you walk into a bank to apply for a loan. The banker tells you your interest rate will be 3%. You smile. It's a good rate. But then, imagine coming back a year later, only to find out the rate has jumped to 6%. You pause and think, what happened? That's the power of interest rates in action. Interest rates might seem like a dry topic, but they influence nearly every part of the economy. From the cost of borrowing for a car or home, to the decisions businesses make about expanding, to the government's ability to manage national debt, interest rates are the silent engine behind economic growth and stability. They're constantly at work, shaping the financial world in ways you might not even realize. Now, to understand how interest rates affect everything from your daily expenses to global markets, we first need to explore what they are and why they matter so much. Let's start with the basics. Interest rates are essentially the cost of borrowing money. When you take out a loan, whether it's for a car, a house, or a business venture, the lender charges you a percentage of the amount borrowed. That percentage is the interest rate. But they don't just affect borrowers. They're equally important for savers. When you deposit money in a bank, the interest rate determines how much the bank pays you for keeping your money there. For example, if you borrow $10,000 at an interest rate of 5%, you'll pay $500 in interest over the year. On the other hand, if you save $10,000 at a 2% interest rate, you'll earn $200 in interest. While these percentages might seem small, when scaled to an entire economy, they create massive ripple effects. Lower interest rates encourage people and businesses to borrow and spend, which stimulates economic activity. Conversely, higher rates push people to save, slowing down spending and often cooling off an overheated economy. But who decides these rates, and why do they change? To answer that, we need to look at how interest rates are set. Interest rates aren't random numbers that appear out of nowhere. They're carefully managed by central banks, like the Federal Reserve in the United States. Central banks use interest rates as a tool to guide the economy toward two key objectives: controlling inflation and promoting employment. For instance, when inflation starts rising too quickly and prices spiral out of control, the Federal Reserve might raise interest rates. Higher rates make borrowing more expensive, which reduces spending and slows down inflation. On the flip side, during economic downturns, like the 2008 financial crisis or the COVID-19 pandemic, the Fed lowers rates to make borrowing cheaper. This stimulates spending and investment, helping the economy recover faster. You can think of interest rates as the thermostat of the economy. When things heat up and risk boiling over, the Fed raises rates to cool things down. When the economy slows and risks freezing, rates are lowered to warm things back up. It's a delicate balancing act that requires constant monitoring, adjustments, and careful planning. This balancing act doesn't just stay within the confines of central banks. It flows directly into our lives. When it comes to individuals and families, interest rates impact your daily life in more ways than you might realize. If rates are low, it becomes cheaper to take out loans for things like buying a home, financing a car, or even pursuing higher education. For example, during the COVID-19 pandemic, mortgage rates fell to historic lows, sparking a surge in home buying. Families saw an opportunity to lock in affordable rates, saving tens of thousands of dollars over the life of their loans. However, when interest rates rise, borrowing costs increase significantly. Imagine a family planning to buy a home with a 3% mortgage rate. If rates jump to 6%, their monthly payments could go up by hundreds of dollars, potentially putting their dream of homeownership out of reach. Rising rates don't just affect mortgages. They make credit card debt and student loans more expensive to manage as well. On the flip side, savers benefit when rates go up. Banks offer higher returns on savings accounts and certificates of deposit, encouraging people to save rather than spend. But for families relying on borrowing to achieve their goals, higher rates can feel like a financial squeeze. While individuals feel these shifts deeply, businesses face an equally significant impact. Businesses, like individuals, are deeply influenced by changes in interest rates. When rates are low, companies can borrow cheaply to fund expansion, invest in new projects, and hire more workers. For example, a tech company might take out a loan to develop a groundbreaking product, creating jobs and driving economic growth in the process. This cycle of borrowing, investment, and expansion ripples through the economy, benefiting multiple industries along the way. But when rates rise, the story changes. Borrowing becomes more expensive, and businesses often delay or cancel big plans. A company considering building a new factory might decide it's not worth the cost of a higher interest loan, slowing down growth. This cautious approach can lead to reduced investment, slower economic activity, and even layoffs. The stock market also reacts to interest rate changes. When rates rise, borrowing costs increase, and investors often move their money from riskier stocks to safer assets like bonds. This shift can lead to stock market declines, reducing consumer confidence and affecting everyone with retirement accounts or investments. And it doesn't stop there. Interest rates also play a critical role on the global stage. Interest rates in the United States have far-reaching effects beyond its borders. When the Federal Reserve raises rates, it can attract foreign investors seeking higher returns, which strengthens the value of the US dollar. While this is great for Americans traveling abroad, as their dollars go further, it can hurt us exporters. A stronger dollar makes American goods more expensive for foreign buyers, reducing global demand. Conversely, when the Fed lowers rates, the dollar weakens. This makes us goods more competitive globally, boosting exports and potentially improving trade balances. This delicate interplay between interest rates, currency values, and international trade shows just how interconnected the global economy truly is. Central banks and governments worldwide closely watch U.S. interest rate decisions. Knowing they can ripple through financial markets and economies everywhere, it's clear that interest rates are far more than just a number. They're a lever that shapes how we live, work, and interact in a complex global system. Interest rates may seem like a small detail in the grand scheme of economics, but their impact is enormous. They influence how much you pay for a home or a car, whether businesses expand or cut back, and how countries compete in the global market. Understanding their role helps you see the bigger picture of how economies function and empowers you to make smarter financial decisions. But interest rates are just one piece of the puzzle. To truly understand the financial world, you need to explore another critical concept: the stock market. Curious about how the stock market works and why it's such a powerful force in the economy? Click on the next video right here. It's a journey into the heart of global finance. See you there.